All right. Hi, everyone. We are live. Welcome to Market Matters. My name is Katie Kuntz, and I'm a social media editor here at CNBC. I'm joined by our senior markets correspondent, Bob Pisani, and today we're going to be answering all of your questions about the latest stock market moves. Nice to see you, Bob.
Hello, Katie. How's things in Los Angeles?
Things have been good. Pretty hot here, but I heard it's been hot on the East Coast as well. So
Yeah, Philly, New York is still about 90 degrees. So, but the weather's been fabulous. It's been a great run, blue skies for 10 days or so.
Beautiful. You have any summer travel plans coming up? I know you were.
I'm going to Ireland later in September. I haven't been there in a long time. I'm going with a friend of mine and my wife, and looking forward to going to some small towns in the south.
Nice. That'll be beautiful. Well, we have a lot of questions this week, so let's jump right into it. We're headed towards the second half. So where do stocks stand now as we approach the second half of the year?
Good. S&P's up 15%. I have an article out today that people want to look at it, Trader Talk. It's all on the earnings situation. TraderTalk.cnbc.com. All the stuff that I do for the web is on that page, TraderTalk.cnbc.com. So we're up 15%. And you all know it's all led, most of it, not all of it, most of it's led by tech. Here's the good news. The good news is those big tech companies, we all know, the Nvidias, the Alphabet, Microsoft, Apple, generally, the earnings are continuing to go up. That's what you want. The most important thing for the stock market is earnings continue to go up, particularly with the market leaders. The slightly warning sign that's out there is that the increase in the earnings estimates is not the same as it was a year ago. And that's a little bit of a concern. So it's not just whether earnings are going up, if the trend is up, but how much is the trend up? So you're up 5% one quarter, you're up 10% the next quarter, you're up 15%. That's good because the rate of change is accelerating. It's the rate of change. And that's not happening. It's decelerating in most of these tech stocks. So that's a little bit of a worry, but earnings are still growing. The other worry that's out there that I see is there's a lot of pushback from consumers about prices. You're going to see these consumer staple companies, these food companies, announce price reductions. McDonald's has already talked about value meals. The fast food restaurants are talking about value moves. The consumer's pushing back, and that's good. That's going to help keep inflation lower. So I see that as a positive on a consumer basis, but it's tough for the companies because it means they're going to be under some kind of margin pressure. So General Mills also commented this week about pricing issues. Here's the good news about all of this. So we have a little deceleration in earnings growth. It's still growing, but it's decelerating, and consumers are pushing back on prices. Despite all of this, overall, the earnings picture is fine. There's almost no change in the earnings estimates for the year. And what this means, realistically, on the whole broad market, is there's no expectations of any imminent recession coming that's out there. So I think that's really good. If you look outside of big cap tech stocks, rest of the earnings, not great. Industrials, fair, but not great. Consumer staples, fair, not great. The real earnings growth is in technology stocks. But look at it this way. Job growth is still strong, but it's moderating. So that's a positive. Interest rates are moderating now. That's a positive. Inflation is moderating more, but still high. I would say the trend is positive there. The consumer is increasingly cautious and pushing back against the prices. That's kind of a negative, but I think good for inflation. So earnings are rising. Tech earnings are rising, but not as much as they were before. Overall, I still say it's a net positive for stocks going into the second half of the year.
All right, so Bob, you talked a lot about tech, and we got a few questions regarding specific tech companies. So let's dive into those. First up is Nvidia. So what are your thoughts on the direction of Nvidia share?
Yeah, so Nvidia is sort of the, like Apple was a few years ago, Nvidia is sort of the star tech stock. So Nvidia is a good example of decelerating earnings expectations. So remember this game about how Wall Street works on the fundamental analysis part. It's about when you own a stock is literally ownership in the company where you are participating in a future stream of cash flows, specifically earnings or dividends. some kind of future stream of returns. That's literally the definition of a stock. So the most important thing here is the trend in earnings. Is the trend up or down? There's a secondary thing that matters here, not just whether the trend is up or down. The trend in tech earnings is up. How rapid is the change in expectations? So in one quarter, we might see technology earnings expectations up 5% over the prior quarter. The next quarter, it might be up 10% over the prior quarter. The next quarter, it might be up 15%. You see the expectations are up. The change is up. So the rate of change is up. That's really good. That's the perfect situation. That's what happened to Nvidia last year. That's why Nvidia went up. All of a sudden, in the first quarter of 2023, analysts started latching on to this AI story and realized Nvidia was the picks and shovels of this game. That's when the estimates started going up, and that's when investors started realizing this, and they just blew up Nvidia's. And if you look at Nvidia's numbers, and this is in the Trader Talk today, tradertalk.cnbc.com, go look at it. You can see that back in the spring of 2023, Nvidia's earnings just blew up. Literally, they went from one quarter to the next, they were up almost 150%. I mean, that's really shocking for a big tech company to pull that off. Then in the next quarter, it was up like 50% over the prior quarter. And then it sort of decelerated from there. In January 2024, when they came out, it was up 30% from the prior quarter. And then, as I recall, it was up 20% in April. And if you look at the July quarter, it's only up about 5%. So the earnings are going up for Nvidia, but they're decelerating. The expectations, are lower. This is not surprising. You can't go up 150% from quarter over quarter. This doesn't happen. So that's a normal thing. What's worrisome is investors keep piling money into Nvidia. And we had Lori Calvasino from RBC. She's very good. She knows this, and she said this yesterday, that this is a difficult situation now, because when you have decelerating earnings growth in a fully priced market, that's a warning sign. So it means that any little thing can suddenly move these stocks 3, 4, 5, 6, 7%. That's why. So you get, when stocks start going down, we had this with Nvidia a week and a half ago, you got momentum people piling out. And then if they see this decelerating earnings growth, you get the fundamental people also saying, well, this has been an amazing run, but the probability to get a lot more out of this, and we've had huge profits, is small. Let's just take profits. So that's sort of the problem. Now, this is what you call rich people problems. It's been a great run, but investors tend to be very late to this game, particularly younger investors who aren't aware of this thing. They think that it just goes up forever. And it doesn't. Nothing does. Tesla didn't do it either. And Tesla had amazing growth. So that's all I would say, is caution people about the valuations. It's the earnings that matter at this point. And it's been a great run for Nvidia, really great. I just don't think they're going to get the massive earnings explosion that they got in the last year and a half going forward.
So next up, let's talk a little bit about AI. Do you think AI is going to take jobs over the next 10 years?
Well, yeah, sure. But that's others are going to be created. Other jobs are going to be created. This is the whole history of technology. If they used to say they don't make any buggy whips anymore. They don't. I mean, what happened to the people who made buggy whips when the automobile came in? Well, they found other jobs. When I was in college in the early 70s, I was a telephone operator in my college. And you pull a wire out of the wall because it's the last mile. So the telephone lines go all the way to the building, but the building didn't connect to the rooms. So that's the telephone operator. You take a wire out of the wall and you connect to the room. Well, in the 50s, 60s, I actually looked this up once. There was like 400,000 telephone operators. And today there's like 4,000, including my job. It went away. What happened to all those 400,000 telephone operators? They went away. They lost their jobs because technology created a way to go to the room. Instead of just going to the building, it went all the way to the room. Well, where did they go, these telephone operators? Can you scream and say, telephone operators, you can't do that because telephone operators will lose their job? No, they found other jobs. So that's what's going to happen with AI. Now, some people say it's more disruptive than other software that's out there, and it might be. But look what AI is going to do. I mean, Just look at customer service. How many times have you called customer service and sat on the phone for half an hour? What if you could get a direct answer, get a chatbot or a virtual assistant that talks like a human being and knows exactly what you want to do when you explain it to them, and you get immediate help, and don't sit there. You all know what that's like. It's frustrating, makes you furious. It's easier to get what you want, easier to get your inquiries answered. What about medical data? We had a company go public a couple of weeks ago, Tempus AI. Tempus AI, you should look them up. They do medical diagnostics, particularly oncology and radiology. They have AI programs read the data, read your medical data, and make comments to your doctor about treatments. Now, obviously, you need a doctor there, but radiology means you read x-rays, right? Do you know what the error rate on radiology test is? It's like 3%, somewhere around there. They might think 3% is not bad, but hey, if that's a life or death question, 3% is a very high error rate. And there is evidence that AI can reduce that error rate. Why wouldn't you want that? And then you say, oh, is it going to displace the doctors? No, it's not. And I'll tell you why. Because nobody's going to pass on a legal liability to an AI. It's not going to happen. They're going to have somebody there to sign off on it. So that's not going to happen. So I see big gains in healthcare, big gains in, this word STEM. I don't know if you all heard this word, but science, technology, engineering, and mathematics. I see big gains in that whole thing. So I think that the benefits of AI far outweigh any of the concerns about loss of jobs. I do think this is a separate question completely. I call it the Terminator question, is, are we going to have smart AI? There's a level of what's called artificial general intelligence, AGI. That means human level intelligence. I think this is attainable now within the next 5 years. I think there's a better than 50% chance that we'll have artificial general intelligence. If you want a new book out, Ray Kurzweil, who helped invent this whole area, he has a new book out called The Singularity is Nearer. It came out this week. He updates his predictions, still predicting artificial general intelligence, human level intelligence by 2029. He has predicted this a long time ago, and so far he's been on track. I would urge you to look at that book. I generally agree with everything he has to say. I'm a big follower of his. Now, the question is further what you call superintelligence. That's like Skynet, and we have no idea when that would happen, but it's possible it could. We're talking about intelligence way beyond humans. We don't know what the motives of such a superintelligence would be. That is a little concerning, and I think people need to think about that. Just think about this. This is the way to look at this. It is highly probable that in the next 5 years, highly probable that there will be non-biological intelligences on Earth. I know that sounds weird, but that's a better way to phrase it than say, oh, we're going to have artificial general intelligence. What the hell does that mean? It means non-biological intelligence. Intelligence that is like you, that can talk to you like it's a real person and actually have a conversation with. And there is a reasonable probability that you may have super intelligences way, way above us, not far beyond that. We don't know when. This is interesting questions. This is an amazing moment in mankind's history here. And it's happening it was happening very slowly for a long time. Artificial intelligence was bogged down for decades, and there have been amazing breakthroughs in the last few years. So I think it's extremely exciting. I'm not worried about technological displacement. I think artificial intelligence is going to help make the world better and a lot more efficient.
Yeah, well, we'll definitely see, what happens over the next couple of years. Next up, Bob, we got a question about Amazon. Is Amazon undervalued? What do you think?
Oh, I don't do that kind of analysis at all. I think Amazon has proven to be an amazing company time and time again. I don't know if it's undervalued or not. I generally don't do that kind of financial analysis. It's quite amazing to me how I've been around since Amazon happened. It was 94 when Amazon went public, and they really started out as basically, a bookstore. And it's quite amazing to see how they've evolved. I would like to see personally more competition. I've been more cognizant of like supporting, for example, local bookstores and things like that. And I think there are legitimate concerns about the company, but I've been a subscriber for a long time. Sorry, I'm not going to get involved in whether it's undervalued or overvalued.
All right. And then next up, we had another tech-related question about European tech companies versus American tech. So do you think that European tech companies could rival American tech companies?
Well, the answer is theoretically yes, but I would ask the simple question, where are they? I mean, name one. Let me think. Okay, so there are some semiconductor equipment companies. They make semiconductors. ASML, that's a big one. They're in the Netherlands. That's a big tech company. There's another one, Infineon. They make semiconductors. They're in Germany. They're big. There's software. There's SAP in Germany. They're big. Go beyond that. There isn't much. Is Spotify a tech company? You know, the streaming company? Yeah. All right. So they're in Sweden. That's about it. I mean, if you look at the reason Europe has underperformed the United States for the last 15 years is because we have the best tech companies in the world. We have the best tech companies anywhere, not just Europe. And that's a major reason why our stock market has outperformed the European stock market. Why aren't there more creative tech companies? I don't know. I mean, I like to think, maybe I'm delusional, that the US has a more entrepreneurial system, easier to do startups, easier to get funding, for example. I like to think that's probably the major factor associated with it. Maybe more entrepreneurial, tech-oriented, creative people. I like to think that that's the reason. I'm not entirely sure, but that makes a lot of sense to me. So the only thing that I have to say about all of this is, where are all those tech companies? They're not in Europe. And there are companies that are tech-oriented in Asia. Korea has companies like Samsung. Japan has a few. But by and large, the most creative companies, the companies that have changed the world since the internet in the last 30 years, are largely American companies.
All right, Bob, our next question. Are we nearing a recession? And if so, what precautions should investors take?
There is no evidence at all we are nearing a recession. We've been doing this we've been expecting a recession since, remember the market bottomed out in September, October 2022, when everybody thought it was an imminent recession in 2023. How'd that work out? Didn't. Now, be careful about being too glib about this, because someday there's going to be a recession. I mean, come on, you got to be crazy not to think there would. The economy goes in cycles. And we had this big interruption with COVID that kind of made a mess out of everything. But it's certainly not irrational to think there's going to be a recession. I'm just saying right now there isn't. Now, 6 months from now, that may have happened. That may happen, and we won't know. But there's no sign of it in the economy, and there's no sign of it in earnings either right now. But again, look down the road. So here's the way to do this. Don't worry about whether there's going to be a recession. Worry about what your risk tolerance is. And a lot of this is dependent on your age. If you're 35 years old, you should have a plan for investing in the market with bonds and, owning a house if you want to do that, and not worry about it at all, because the stock market goes through recessions and comes out on the other end just fine. I do not think that anybody, and go ask any financial advisor, they'll tell you, should try to market time a recession. That is a very bad idea. Have a plan. What is your risk tolerance for owning stocks, owning bonds, owning a house, having money in cash? How do you feel? If you're closer to retirement, closer to 70, I'm older myself, maybe you have a little less risk tolerance. Maybe instead of, when your 401k is 70% in stocks, you'd have 60% in stocks or less. You need to figure that out for yourself. The only thing you should not do is something stupid and think that you could time the markets, that you know when to get in and when to go back in. You don't. Disabuse yourself of that idea. That's the one thing you should take away. You should have a consistent plan. And if you're not sure how to do it, then you should find a financial advisor that's reasonably priced, and you should consult with that financial advisor and have a plan. The worst thing is thinking that you can make it up as you're going along, not have a plan, because then you're not going to have a plan. You're just going to do things up and down, and you're going to find that it's not going to work long term.
Well, I think that rolls nicely into our last question for today, which is, where do Americans stand when it comes to saving and investing for retirement?
Well, I did a story on this week again. Sorry to toot my horn here, but you can go to tradertalk.cnbc.com. Vanguard, who I'm a big backer of Vanguard, close to Jack Bogle, the founder of Vanguard. Vanguard there's a study every year called How America Saves, and it just came out this week. And it's very interesting what happened. They're the second biggest 401k sponsor. I think Fidelity is the largest one, but we're dealing with 5 million accounts here. It's a lot of accounts. So the good news is the stock market's been up, so people's balances have been up. Duh, that makes some sense. There's better news, though, when you look at what's going on here. Number one, plan participation rates are at all-time highs. So more people are invested in 401ks. And one of the reasons this has happened is they've switched the opt-in and opt-out. So years ago, when you got a job, you got a 401k, but you had to opt into it. And it turns out a lot of people did not opt in, even though your employer usually matches you and gives you free money. A lot of people didn't. And this is an interesting behavioral economics problem. A lot of people didn't because they're ignorant. They're not sure how it works for whatever reason. So they changed the rules a few years ago. And a lot of these companies now can automatically enroll you. In other words, you are opted in immediately, and you have to opt out if you don't want to. And what's happened is the participation rates have gone way up. It's a brilliant idea, and it's been successful. The other thing that's important, I think, overall, is just the way the business has changed. The savings rates are higher too. People have gotten better on it. So I'm trying to figure. I don't see it in my notes here, but the average participant had like 7.5% in their savings, and if you included in the employer, there was a match. It was about 11%. These were very good numbers overall. So participation rate is up. People are saving more. All this is great because people need to save more for their retirement, and they don't. So here's the downside. I looked at the numbers of how much money people had in these accounts, and there's enormous difference between the median and the average. So I'm going to take people who are towards retirement, 65 plus. The average 65 plus account at Vanguard had $270,000 in it. Now that sounds like a decent amount of money. Here's the problem. The median had $88,000. The median means half had more, half had less. So why is there such enormous difference between the median at $88,000 and the average account at $270,000? And the reason this happens is the people who are at the very top, there's a small group of super savers. They're able to get $2 million in their account, 3 or 4 million. They drag the averages up, but they don't change the median that much. So in this case, you really ought to look at the median. So think of it this way. The average 401k account at Vanguard for a person who is 65 or older, 65 to whatever age plus, is $88,000. 50% have more, 50% have less. I know about you, but that doesn't impress me at all. Not for a person who's 65. If you're 35, I'm impressed, but not 65. That's not a good number. So think about, I did some retirement math, simple retirement math for the story I did in Trader Talk. And you normally would withdraw when you're in retirement about 4%. That's a standard number. So you do 4% of $88,000, you get something like $3,600 a year. That's not much. Then let's look at the other things you might be getting. Social Security. The average Social Security check is about $20,000 a year. Okay, so now we got $3,600 plus $20,000. The other thing that people use are pensions. It turns out pensions are a vanishing breed these days, but the average pension is close to $10,000 private. Some government employees, they make more. They get a bigger pension. But let's use $10,000. So here you got 3 sources of income. You're pulling out $3,600 from your 401k, $20,000 from Social Security, and you're pulling out close to $10,000 for a pension. Let's assume you're getting all 3 of these. That's about $33,000, somewhere around there. So, okay, let's think. Is that good or bad? Well, let's put it this way. You can do that. You can live on $33,000 a year, but you are likely not going to have a mortgage. You're going to need to own the house, and you're likely going to have to live in a lower cost part of the country. You're certainly not living, in New York, or Philadelphia even would be tight. So I guess it's doable, but it's hard. Now, some people have other sources of income. Some people have more than one 401k. That would be good. Here's what happens that makes this tricky, Katie. If you look at the satisfaction levels, people are asked, how is your retirement looking? How do you feel about it? People who have multiple sources of income, like Social Security, a 401k, and a pension, generally report higher levels of satisfaction. They say, I'm okay. People who don't have other sources, like a 401k, I think 55% of retirees have 401ks. The other 45% don't. Pensions, only about 50% of retirees have pensions. The other 50% don't. So if you start taking out those other sources of income and get down to people whose primary source of income is just Social Security, the levels of anxiety go much higher. They say, I'm nervous. I don't think I can do it. I'm not sure. So this is a very tricky question about retirement. And the basic idea that I have used for 20 years is people aren't saving enough. They need to save more. And I made this mistake. My whole generation did, baby boomers. They didn't start saving at all until their 30s. I actually did not have a 401k. I didn't have any retirement account at all until I joined CNBC in late 1990, and I was 35 years old then. That's late. There is some sign that the kids today in their 20s are saving earlier. That's great. It makes me happy whenever I see that. And I would tell everyone out there, think carefully about what your retirement. I know when I turned 35 and joined CNBC in 1990, the idea that suddenly I'd be almost 70, 40 years later 34 years later, is kind of crazy. But it happened, and it does happen. So I'm glad that I had to save very aggressively at CNBC. You get a crash course in how to save money and retirement working at CNBC, believe me. But I wish I would have done something a little earlier. And I wrote about it in my book, Shut Up and Keep Talking, which you can get on Amazon, and how stupid I was and what I had to do to catch up. So my only advice to everyone is save more, save as much as you possibly can. And you're going to be retirement age sooner than you think. It's amazing how fast the years go by.
Yeah, I'll say that working at CNBC was my first job right out of college, and I feel very lucky for that because I learned a lot about saving from an early age. So, and it's also very interesting how this all comes back to the behavioral science elements and like removing those barriers, like you were saying with the opt-in plans.
It's quite amazing how what it does. People make irrational decisions all the time that not necessarily in their best interest. And again, I would encourage people to have an understanding of that. Like 401ks, your employer generally matches your contribution. So if you put away 4% of your salary in a 401k, in most plans, your employer will give you 4%. That is free money above your salary. A rational decision would be to opt in and do that. And yet it was shocking how many people don't do that. And if you explain it to them, they'll look at you and say, oh, yeah, that makes sense. But they don't actually do it. So human beings are sometimes ignorant, sometimes willfully decide they don't want to do it, even though it's against their economic interests to do it. And having a better understanding of that, of the way humans are, will help you overcome those barriers. You should take free money when it's given to you.
Yeah, definitely. Well, thank you, Bob, for answering all of our questions. I encourage everyone to go and read Bob's Trader Talks on CNBC.com, and we'll talk to you again in a few weeks.
Thanks, guys. Good questions.